Inflation is bad. When a government issues more and more currency to solve its problems, and there's a strong tendency to do this, two things result. One, inflation may significantly depreciate the value of money between the time it is received and the time it is spent. In hyperinflationary environments, you literally take your money and run once you're paid to the store to spend it before the prices go up. You'll recall the third function of money was as a store of value. So inflation very much can destroy that function of money. Two, sellers will not know what to charge and buyers will not know what to pay. Let's say you're in a hyperinflationary environment, like in Zimbabwe, and you go and buy a steak, and it's $100,000 Zimbabwean dollars, and you think, well, what last week this was $10,000. How much am I really spending? You begin to get confused, and so money's function as a yardstick of value is also destroyed. If it gets bad enough, short of government force, people will stop taking the currency, and so the main function of money as a medium of exchange is destroyed. So inflation is a bad thing. It must be regulated somehow. In America, inflation is regulated by a central bank called the Federal Reserve Bank. And to give you some historical background, we didn't have one after the 1830s, and Congress decided in the very early 20th century that the U.S. banking system needed some centralization and public regulation to be more efficient. It was decentralized, it was completely unregulated, banks could do whatever they wanted to, and different separate private banks issued their own banknotes. There were lots of kinds of money actually circulating around, and it was very mismanaged. Sometimes there was too little money in the economy, sometimes there was too much. Deflation and inflation reigned whenever they wanted to. There was a major financial panic, 1907, the Panic of 1907. It was brief but severe, and it was resolved by the machinations of John Pierpont Morgan, a private banker who arranged a bailout for the nation. And Congress said, we need to look at this. We shouldn't be relying on a private individual. And they created something called the National Monetary Commission to study the banking system and outline a course of action. And it was a good commission. The results were some recommendations that were crafted into the Federal Reserve Act of 1913, signed by Woodrow Wilson, which established the Federal Reserve System, which is commonly called the Fed. Now listen carefully. Here's how the Fed is organized. The president appoints a board of governors to run it, 7 people. He appoints them, and they serve 14-year terms, but they're staggered every 2 years, so one of them rolls off. So therefore, we have a lot of continuity and solidity on the board. It also insulates the board as much as possible from politics. This is sort of like the Supreme Court, except that they're appointed for life. Yes, they're appointed by political figures, but once appointed, they're sort of out of the reach of the scope of politics, and we want control of the money supply out of the reach of politics. The president, among the 7 governors, picks 2, one of whom he elevates to the position of chairman and the other as vice chairman. And during their tenure as governor, they serve in these capacities for 4-year terms. They most often have been extended, in one case to the point of 20 years. So these are long-serving people. Now, the Board of Governors manages not a bank, but a system of banks. The Federal Reserve System is a system of 12 regional banks. The banks are quasi-public. Theoretically, they're owned. They're run by this public entity appointed by the president, but they're privately owned because when the system was started, let's say in San Francisco, would say, all right, Bank of America, you're going to put up $10 million, and Bank of Italy, small bank in San Francisco, you're going to put up $5 million. And so really the private banks theoretically own the Federal Reserve regional banks and appoint their presidents. So, but it's managed by a public entity, the Board of Governors. So it's quasi-public private. It's a clever invention. It serves as a banker's bank. You can't open an account at the Fed, but banks are the people who loan money from the Fed and who deposit their money in the Fed. The most important committee in the Fed is something called the Federal Open Market Committee. We'll talk more about that phrase, open market, later. But the FOMC, this is a policy committee which sets monetary policy. And when I say set monetary policy, it decides whether to raise or lower the amount of money in the economy. And you'll quickly learn that also means they're raising and lowering interest rates. The FOMC is composed of 12 members. Among them, all 7 members of the Board of Governors, including the chairman and the vice chairman. The president of the New York Fed, regional Fed, he's always on it. Why? Because that's the most important one, and because the New York Fed is instrumental in conducting the operations with which the Fed raises and lowers the money supply. More about that later. And the other 4 members, that's 8, the other 4 members are the other 11 Fed presidents who serve on a one-year rotating basis. Right now, for example, I believe the president of the Richmond Fed is on the FOMC, which meets approximately every 6 weeks or so. So what does the Fed do? Well, first of all, it now issues all U.S. currency. If you pull out a bill, you'll notice at the top it says Federal Reserve Note. It sets reserve requirements, and it holds reserves. It says to a bank, for example, you have to keep 10% of your deposits in reserve. You can't loan them all out. And you'll keep that with us, by the way. You'll deposit that money here at the Fed. It lends money to banks when they need it. It provides for check collection. If you bank at Regions and you write a check to your friend who banks at Wachovia, how does Wachovia get the money? Well, the Fed helps provide a system to do that. 5, it acts as a fiscal agent. Fiscal means financial in relation to a government. Specifically, it acts as the fiscal agent of the U.S. federal government. The only people that can have accounts at the Fed or other banks are the U.S. federal government. Their checking account is at the Fed. 6, it supervises banks, telling them, for example, what their lending standards should be. And 7, and most important by far, which is why I put it in red, it controls the money supply. The Fed is awesomely powerful. It can raise and lower the money supply with no more than an agreement of that 12-member board, regardless of what Congress or the President says. How it does that, we need to understand a little bit more about banking, and that's what we're going to talk about next time.